Now let's move on to this particular question. Faulty goods costing $210 were returned by Henry to the supplier. Henry recorded this as $120 in the general ledger accounts. State the accounting entries required for Henry to correct the error. Okay, so faulty goods costing $210 were returned by Henry to the supplier. However, Henry recorded this particular return as $120 instead of $210. So what should have been the correct entry? When faulty goods costing $210 are returned to the supplier, the original entry should have been the supplier account or the accounts payable account should have been debited by $210, so that this will reduce the amount owed to the supplier, and it has to be credited to the purchaser's return account by $210. So as a result of that, this will reduce the purchases due to the return. However, what Henry has done, he has recorded instead of 210, he has recorded it as $120. So therefore, Henry incorrectly recorded the return as $120 instead of $210, resulting in a shortfall of $90 in both the supplier account as well as the purchaser's return account. So to correct this error, what we need to do is we need to adjust the difference between the actual cost of the faulty goods, which is $210, and the recorded amount of $120, which is $90. So the correcting entries will be, you need to debit the supplier account or the accounts payable account $90. So this increases the reduction in the amount owed to the supplier to the correct value of $210. Then you need to credit the purchaser's return account by $90. This increases the purchase returns to reflect the full amount of the goods returned. So therefore, the supplier account was under debited by $90, so it needs an additional debit, and also the purchase return account was under credited by $90, so it needs an additional credit. So therefore, the correct entry will be to debit the accounts payable account by $90 and to credit the purchaser's return account by $90. Now let's move on to this particular question. Taylor's draft accounts for the year ended 31st July 2018 had a profit of $36,834. On investigation, Taylor discovered the following. A contra for $1,125 between the receivables and payables general ledger accounts had not been recorded. A contra for $1,125 between receivable and payables had not been recorded. The fixtures and fittings depreciation charge amounting to $870 had not yet been accounted for. Okay, so these two entries have not been accounted. So this balance is prior to these adjustments. Okay, so what was the adjusted profit for the period? Now to calculate the Taylor's adjusted profit, what we need to do is we need to analyze the adjustments required based on the given information. First of all, let's look at the contra between receivables and payables. What is the impact on the profit? A contra entry involves offsetting the receivables and payables with the same amount. Okay, so when you have a receivable account, it's usually a debit balance, and accounts payable is a credit balance. So when you offset, what you need to do is you need to credit the accounts receivable, this is accounts payable, you need to credit the accounts receivable, and you need to debit the accounts payable. So you debit accounts receivable and you credit accounts receivable and you debit accounts payable, so that you can offset receivable versus payables. But what is the effect on profitability? None. A contra entry does not affect the profit because it does not involve income or expenses. So these are simply assets and liabilities. Okay, so we are offsetting assets against liabilities, therefore it's a balance sheet impact. There is no impact on the profitability. Then the second one, depreciation on fixtures and fittings. What is the impact? Depreciation is an expense, so that reduces the profit. So therefore the depreciation amount, the charge for the period is $870 had not been recorded. So this is the $870. So what is the effect on profitability? So profit decreases by $870. So this is an expense. So therefore your profit is given. So therefore your profit is given as $36,834 before adjusting for the depreciation on fixtures and fittings. So therefore once you make an adjustment to this, the adjusted profit will reduce by $870. So therefore your adjusted profit will be $35,964. So this is the answer for this particular question. Now let's move on to this particular question. Okay, now let's move on to this particular question. An entity AG company purchased an item of plant on 1st January 2020 for $38,000. Although the payment for the plant had been correctly accounted for, it was treated as a repairs and renewal expense. Okay, so the AG company has purchased a plant. It's a fixed asset. However, it has been treated as repairs and renewal expense in the general ledger. AG company charges depreciation using the straight line basis at 20% per annum, with a proportionate charge in the year of acquisition and assuming no scrap value at the end of the life of the asset. How will AG company profit for the year ended 31st March 2020 be affected by the error? Okay, so this asset was purchased on 1st January 2020 and the financial year end is 31st March 2020, and also the plant has been treated as repairs and renewal expense. So what is the effect on the profitability? What is the error? As a result of this error, what is the impact on the profitability? You are given 4 answers, of which we need to identify the correct answer. Okay, so to determine how AG company's profit is affected by the error, so let's analyze the situation step by step. So you are given set of information. So let's analyze the key information given. Okay, cost of the plant is 38. Cost of the plant is 38,000. Cost of the plant is 38,000 and the date of acquisition 1st January 2020, and the depreciation rate is 20% per annum straight line basis. Proportionate depreciation has to be charged. So this has to be charged from 1st January until 31st March 2020. So only for 3 months depreciation has to be charged based on the proportionate depreciation. What is the error the company has made? The plant was incorrectly treated as repairs and renewal expense, fully deducted from profit. Okay, so this is the asset value 38,000. This has been charged as an expense. So therefore the profit has been understated. So what is the correct treatment? The plant should be capitalized and only the depreciation expenses should be charged, and as a result of that it will reduce the profit. So depreciation for 3 months will be, we need to calculate 38,000 times 20% for 3 months. So which is going to be 1,900. So what is the impact? So what is the impact of the error? The full 38,000 was incorrectly recorded as an expense, overstating expenses by 38,000, and the correct expenses should have been only 1,900, which is we calculated. So as a result of that, so what should be the adjusted profit? The overstatement of expenses 38,000 minus 1900, that is the correct expense, which is the depreciation. So 36,100. So therefore the profit is understated by 36,100 and you have overstated the expenses by 36,000. So your correct answer is, so therefore the correct answer should be the profit is understated by 36,100. This should be the correct answer. Now let's move on to the next question. Mary's draft accounts for the year ended 31st October 2015 had a loss of $26,834. On investigation, Mary discovered the following. A debt due of $750 should be written off as irrecoverable. Okay, so a debt due of $750 to be written off as irrecoverable. The allowance for receivables should be reduced from $2,350 to $1,980. The fixtures and fittings depreciation charge amounting to $870 had not yet been accounted for. So what was the adjusted result for the year? Okay, so now you are given a loss of 26,834, and after making these adjustments, so what should be the adjusted result for the year? So it can be either profit or loss. So you need to delete which does not apply. Okay, so to determine the adjusted result for the year, what we need to do is we need to analyze how each adjustment affects Mary's draft loss. So now let's go through the adjustments one by one. So these are the given information. You are given a draft loss of $26,834. So these are the required adjustments. Write off a debt of $750 as irrecoverable. So when you write off a debt as irrecoverable, that will be an expense. So expenses will increase the loss. And the second adjustment is reduce allowance for receivables by, the second adjustment is to reduce the allowance for receivable. So this amount will reduce by $370 because there was an opening balance of $2,350. However, the year end, the provision or the allowance should be $1,980. So therefore, you need to reverse the expenses originally provided for. So originally we provided $2,350. Now you need to reduce the provision to $1,980. So therefore, this is a reversal of expenses. So therefore, it will reduce the loss. Third adjustment is depreciation on fixtures and fittings of $870. So if you take, when you take the allowance account, this is the allowance account. The opening balance is a credit balance 2,350. So when you make the closing balance 1,980, okay, so this is the brought forward balance. So this is the carried forward balance. So therefore, in order to make this 1,980, when you balance this 2,350, 2,350, so difference of 370 to be transferred to the profit and loss account as a credit. So when you credit the P&L account, the losses will reduce. The next adjustment is depreciation on fixtures and fittings of 870 has not been recorded. So therefore, this will be treated as an expense. Therefore, it will increase the loss. So impact of adjustments, write off irrecoverable debt. This increases the loss by 750. A reduction in allowance for receivable, this reduces the loss by $370. Depreciation expense, this will increase the loss by $870. So your calculated adjusted loss or the profit will be to the loss. What you need to do is 26,834 is the loss. You need to add back write off 750 and you need to reduce the loss by 370. Again, you need to add back 870 for the depreciation expenses. That will increase the loss. So once you make these adjustments, your adjusted loss will be 28,084. So this is the answer for this particular question. Okay, let's move on to the following questions. This is in relation to financial accounting, ACCA financial accounting FA. The first question is, an inventory record card shows the following details. February 1st, 60 units in inventory at a cost of 12 per unit. So this is the opening. This is the opening stock value. This is the opening stock value, 60 units at the rate of 12. Okay, so we can take 60 units at the rate of 12. This is the opening balance. Opening balance. Then on 5th February, 100 units purchased at the rate of 14. So this is the new addition, the purchase 100 units at the rate of 14. Then sold 80 units. 80 units were sold. Now we don't know at which rate this will be recorded. This will be depend on the stock valuation, the stock method that they use. Then on 18th February, 40 units purchased at 16. This is sold, and this is the purchasers again 40 at the rate of 16. Then again 70 units were sold. Okay, again we need to identify what is the stock valuation method. Based on that we need to issue. What was the value of inventory at 28th February using the first in first out method? So they use first in first out method, FIFO method. Okay, so based on that let's calculate. Now 60 units at the rate of 12 and 100 units at the rate of 14. So the total quantity available, 60 at the rate of 12 and 100 at the rate of 14. Okay, now from this 160, 80 units sold. 80 units sold. Since we are using, then the balance will be 80. Since we use the FIFO method, okay, of this 80, 60 will be issued from this quantity, and the remaining 20 will be 60 from this particular stocks and 20 from 100. So the available 80, this available 80 is from these stocks, which is at the rate of 14. Okay, then again they purchase 40 units. So you had 80 units at the rate of 14. Now again on 18th February you purchase 40 units at the rate of 16. Now you have available stocks 120. Sold 70 units. Sold 70 units. Now you have balance of 50. Now this 70 units will be first issued from the first available stocks, which is 80. Okay, so therefore this 70 will be issued from this 80. So therefore out of 80, 70 when you issue, the remaining stock will be 10 at the rate of 14, and you are left with this 40 also, 40 at the rate of 16. So this will be the closing inventory value based on the FIFO method. So if you take 10 times 14, 140, plus 40 times 16 will be how much? 640. So therefore the total will be how much? 780. 780. So your correct answer will be 780, the last one. Okay, this is the answer for the first question. Now let's move on to the next question. Stationery paid for during the year amounted to $2,200 US. At the end of the year, inventory costing 150 had been received but not yet invoiced by the supplier. At the start of the year, there was an accrual for unpaid stationery for $120. So what was the expense for stationery included in the statement of profit or loss for the year? Now if you take the stationery expense accrued account, okay, this is the T account. This is the T account. Okay, stationery payable account. Okay, so what they are saying is stationery paid during the year amounted to 2200. So when you pay, you credit bank account. Okay, you will credit bank account, you debit the stationery account. Okay, so here the bank account will be credited and here the expense payable account will be debited. At the end of the year, inventory costing 150 had been received but not yet invoiced by the supplier. So that means this is payable. This is the payable to the supplier. So therefore, since it is not yet paid, what you need to do, you need to carry forward this balance as a payable balance. Balance carried forward 150. So this will be the balance brought forward 150 to the next financial period. At the start of the year, there was an accrual for unpaid stationery 120. So there was an opening balance brought forward of 120 payable. So what was the expense for stationery included in the statement of profit or loss? So when you take this, that will be the profit and loss charge to be charged to the P&L account. So here you will credit and debit the P&L account. So when you take the total 2350, 2350, and the amount will be 2230. So this is the answer for this particular question. The amount to be charged to P&L account is 2230. So let's move on to the other question. The other question, let's go through the question. AG's machinery cost account showed a balance of $7,500 at 1st January 2015. Okay, so this is the opening balance. During the year, AG had the following transactions. 31st March, disposed of machine costing 450. Then 30th June, acquired machine costing 1,800. 31st October, disposed of machine costing 750. AG depreciates machine at the rate of 12 per annum on the straight line basis based on the number of months ownership. What was the depreciation charge in respect of machinery for the year ended 31st December 2015? Okay, now they charge depreciation based on the number of months of ownership. Okay, so therefore if you take the opening balance 7,500, if you take the machinery account, there was an opening balance 1st January 2015 7,500. This is the opening balance, brought forward balance. And 31st March, machine worth 450 was sold. So 31st March, the cost will reduce by 450 on 31st March. And on 30th June, acquired machinery costing 1,800. So on 30th June, they acquired, okay, so they would have credited bank account or the payable account. So let's say it is paid by cash, so bank account, and here 1,800 debit. Again 31st October, disposed of machinery costing 750. 31st October, sold 750. Okay, now when you calculate the depreciation on straight line basis based on the number of months ownership, so we need to calculate, for example, now on 31st December this 450 was sold. So if you take the number of months these assets were held in the company, 450, this particular asset was held for 3 months. So therefore this has to be calculated for 3 months at the rate of 12%. Then if you take this particular asset 750, 31st October 750, this particular asset was held for how many months? 10 months. So therefore for 10 months you need to depreciate this particular asset. Then in addition to that, company has bought 1,800 on 30th June. So 30th June additional asset was acquired 1800 at the rate of 12%. Since this was purchased in June for 6 months. We need to depreciate for the remaining period. And the opening value of 7,500. Then the opening value of this 7,500. Okay, the 7,500. This was the opening balance from 1st January 2015. So of this 7,500, they sold 450 and again they sold 750. If you take the assets which were held throughout the year, what is the value of the asset that was held throughout the period? 7,500 minus 450 minus 750. So that amount will be 6,300. So the total 6,300 remaining asset value has to be depreciated at the rate of 12% for the full year, because these assets were held throughout the year. Okay, so basically this 450 we need to depreciate for 3 months, because this particular asset was sold on 31st March 2015. So therefore this was held only for 3 months. Then subsequently on 31st October 750 worth of assets were sold, and therefore these assets were held in the company for 10 months. So therefore 10 months depreciation has to be charged. And in addition to that, on 30th June they bought a new asset worth 1,800 that was bought on 30th June. So therefore the remaining period will be depreciated. So therefore only for 6 months we need to depreciate. Then the remaining asset value, which is 6,300, has to be depreciated for 12 months period, because this was held throughout the period. Okay, so when you take the depreciation for this 450 for 3 months, so that will be 13.5. Then 750 for 10 months at the rate of 12 is going to be 75. 1,800 times 12 times 6 months will be 108, and plus 6,300 times 12%, which is going to be 6,300 times 12%, 756. So 756 plus 108, 75 plus 13.5. So the total depreciation amount will be 952.5. So this is the answer for this particular question. So what was the depreciation charge in respect of machinery for the year ended 31st December 2015? It's going to be 952.5. So this is the answer for this particular question. Hi everyone, welcome to the session. Let's try to answer these mock type questions. The first question is, extract from the equity section of the statement of financial position of Beta Limited as at 31st December 2020 is given below. Share capital account is $1 each. The value is $150,000 and the share premium is 40,000. So these are the opening balances as at 31st December 2020. During the year ended 31st December 2021, Beta Limited issued 120,000 shares, $1 each, ordinary shares for $5 each. So what was the balance on the share premium account? So we had an opening balance of 40,000 US dollars. After issuing this, what will be the closing balance? Okay. The answer is 520. How did we arrive at this number? Basically, your nominal value is $1 and these shares are issued at $5. So the issue price is $5 and the nominal value is $1. So that difference multiplied by the number of shares issued. Number of shares issued will be 120,000 shares. So here issued price 5, nominal value is 1, 120,000 shares were issued. So therefore the share premium for the issued shares will be 480,000 plus we had an opening balance of 40,000. So once you add opening balance to the new balance, that will be 520,000. So this is the correct answer for this particular question. Now let's move on to the second question. Which two of the following errors could not occur in a computerized accounting system? Okay, let's go through. The first one is the discount received balance was listed as a debit on the trial balance. Okay, a discount received balance was listed as a debit balance on the trial balance. The second one, dividend paid ledger account balance of 1,200 was recorded in the trial balance as 1,000. There was a balance in the dividend paid ledger account 1,200 that was recorded in the trial balance as 1,000. Is it possible in computerized accounting system? So this is what we need to answer. A contra settlement was recorded in the receivable and payable general ledger accounts but had been reversed when recording the transaction. Okay, an item of asset expenditure was recorded as a maintenance expenses. Okay, if you take the first one, a discount received balance was listed as a debit on the trial balance. Can this happen in a computerized accounting system? In a computerized accounting system, the discount received account is automatically recorded in the correct side of the trial balance. So therefore, this cannot be misclassified as a debit balance in the trial balance. So whatever the balances in the ledger accounts will be picked automatically to the trial balance. So therefore, these kind of errors will not happen in a computerized accounting system. The second one, similarly, the ledger balances are picked automatically by the system. So you have a ledger balance of 1,200. This will automatically pay to the trial balance. So therefore, if the dividend paid ledger account balance is 1,200, it will correctly appear as in the trial balance. So there is no manual intervention that could lead to an incorrect figure being reported. Okay, so whatever the balances in the ledger, that will be recorded in the trial balance automatically. There is no manual intervention. So therefore, these kind of errors also cannot happen. Third one, a contra settlement was recorded in the receivables and payables general ledger account but had been reversed when recording the transaction. So when the accountant records these kind of transaction, he might make mistakes. Okay, so this type of error could happen during manual entries where an accountant might mistakenly reverse the transaction. So these kind of entries could happen. Okay, and the last one is an item of asset expenditure was recorded as a maintenance expenses. So this also can happen because this error could also happen if the accountant selects the wrong account for recording the expenditure. So when you select the proper account instead of selecting the asset account, if he had selected the expense account, so this can be recorded in the computerized accounting system. So therefore, the correct answer is A and B. Which two of the following errors could not occur in a computerized accounting system? So the first and the second one. Now let's move on to the third question. Business paid insurance premium 15,000 US dollars during the year ended 30th June 2014. At 30th June 2013, there was an insurance prepayment of 1,200, and 30th June 2014, there was a prepayment of $900. So what was the insurance expense for the year ended 30th June 2014? So we need to identify the insurance expenses charged to the profit and loss account. So if you open up the prepayment account, this is the prepayment account, prepayment of insurance. So let's take the opening balance first. there was an insurance prepayment of 1200 at the beginning. So therefore, so your balance brought forward was 1200. And 30th June 2014, there was a prepayment of 900. So therefore, there was a closing balance. So closing balance will be balance carried forward. That's going to be 900 US dollars. So this will be the carried forward balance to the next financial period. So balance brought forward 900. Okay. So during the year, there was a payment of 15,000 US dollars. So when you pay this, you would have credited the bank account. Okay, you would have credited the bank account, and this amount has to be debited to the prepayment account. Okay, bank credit, debit the prepayment account. So what is the expense charge to the profit and loss account? So this is what we need to identify. What is the amount to be charged to the P&L account? So if you take the total 16,200, 16,200. So here the balance will be 15,300. Okay, so this is the amount to be charged to the profit and loss account as prepaid expenses, insurance expenses. Okay, the fourth question. At 30th December 2014, business wrote off two debts 900 and 1,250 respectively. It also required an allowance for receivable of 7,500. The allowance for receivable balance as at October 2013 was 8,400. What was the irrecoverable debt expense for the year ended 30th September 2014? So let's open up this account. Irrecoverable debt expenses account. Okay, and also we need the allowance for receivable. So this is the provision account. The provision account, when you take the allowance for receivable, the provision balance was 8,400. So let's take the provision balance brought forward 8,400, and they wanted a balance at the year end, which is 30th September 2014, to be 7,500. See, it also required an allowance for receivable 7,500. So this 8,400 was opening balance. This was 2013 opening balance. So 2014, they want a carried forward balance of 7,500. So if you take 7,500 at the year end, this is the opening balance. So which means there was an over provision of how much? It was 8,400. Now you need a provision of allowance for receivable of 7,500. There was an over provision. So therefore this over provision has to be reversed to the profit and loss account. How much is that? 900 to be reversed to the irrecoverable debt expense account. Okay, this amount will be reversed because there is an over provision. It has to be credited. Apart from that, they are saying a business wrote off two debts 900 and 1,250. So when you write off, what is the double entry basically? So you need to credit the receivable account, the debtors account. For example, if you, let's say you have an accounts receivable account, it will be usually a debit balance. So when you write off, you need to credit the accounts receivable. How much? 900 and 1,250. So you credit accounts receivable and debit the irrecoverable debt expenses. So therefore you can say bad debts 900 and 1,250. Okay, so what was the irrecoverable debt expense for the year? Okay, so when you balance this account, you will have the net amount to be charged to the profit and loss account that will be how much? 5 2350, 2350, sorry, 5 9 11 2150, and here 1250. Okay, so this is the amount to be charged to the profit and loss account. So this is from the allowance account, which is this 900. Okay, so this is the correct answer for this question. Okay, now let's move on to the other question. A sole trader purchased a machine for 1000 for long-term use. The sole trader incorrectly posted the following double entry: repairs and expense account 1000, bank account credit 1000. So what type of error is this? Extraction error, error of omission, error of commission, error of principal. So we know this is a principal error because this is a capital nature expenditure has been recorded as revenue expenditure. So this error arises because the transaction was recorded in the wrong account. A capital expenditure was incorrectly treated as an expense. So fundamentally misrepresenting the nature of the transaction. So therefore this is error of principal. Okay, now let's move on to these questions. These questions are relating to capital structure and finance cost. This is relating to ACCA financial accounting. State whether each of the following statements about a right issue of share true or false. Okay, so you need to answer these questions, these two questions, whether these are true or false. A right issue capitalizes the entity's equity reserves. No, it does not capitalize, because the right issue is normally issued to the existing shareholders at a discounted price compared to the market value, market price. So therefore it does not capitalize the entity's equity reserves, which can be a disadvantage as this can reduce the amount of reserves. Now we don't transfer the reserve to the equity account. That is known as bonus share issue. So the right issue, we receive cash and we have to create a liability. So therefore this is false. A right issue is offered to the existing shareholders. Yes. Is usually at a discounted price. Yes. Compared to the nominal value of share. No. Compared to the market price. The market price. So therefore the answer is false. So next question. Which two items within the statement of financial position or the balance sheet would change immediately following the issue of redeemable preference shares? So redeemable preference shares is a liability. Please remember, this is a liability because once it is the period is over, we need to settle to the preference shareholders. So therefore, what is the immediate change to the financial position? Once it is issued, the company will receive cash. So therefore, it will impact the bank account, and also you create a liability. So therefore, it will be a long-term liability, which is basically more than 1 year, the long-term liability. So immediately these two accounts will change. Usually you debit the bank account and you credit the long-term liability account. So it will not have an impact on retained earnings immediately, and also the finance cost immediately, and equity account also. So the impact will be in bank account and the long-term debt account. Statement of financial position of Cartwright company shows closing retained earnings of 325,688. The statement of profit or loss showed a profit of 79,285. Cartwright company paid last year's dividend of 12,200 during the year, and proposed dividend 13,500 at the year end. This had not been approved by the shareholders at the end of the year. What is the opening retained earnings? Okay, so now you are given the closing retained earnings. Okay, so if you identify opening retained earnings, you need to identify to the opening retained earnings whatever the profit you earn, you have to add back. Okay, so the profit has to be profit or loss. If it is a profit, you need to add back. It's a loss, you have to deduct. and whatever the dividend paid during the period, dividend paid has to be deducted. Okay, so then you will arrive at this closing retained earnings. Closing retained earnings. So closing retained earnings are given 320,568. Okay, and also dividend paid is given 12,200. So that amount has to be deducted from the opening retained earnings, and also you need to add back the profit 79,285 from the opening return earnings. But the opening return earning is not given. So therefore what you need to do to arrive at opening return earnings, so you have to reverse these entries. So 320,568 you need to add back, you add back this and you deduct this amount to arrive at the opening return earnings. So once you do that, your answer will be 320,568 plus 12,200 minus 79,285. So it is 253,483. So this is the correct answer. Okay. Now next question. Gearing company had profit before tax 68,000 and a tax charge of 32,000, resulting in a profit for the year of 36,000. So 68,000 minus 32,000 will be 36,000 for the year ended 30th April 2005. In addition to the profit above, gearing company paid a dividend 21,000 during the year. A gain on revaluation of land resulted in revaluation surplus of 18,000. Okay, so this is not recorded in the equity return earnings. It is recorded in the comprehensive income statement. So from 36,000, okay, minus 21,000 dividend paid will be how much? So it will be 15,000. Okay, the correct answer should be $15,000. What total amount will be added to retained earnings at the end of the financial year? So that's going to be 15,000. Okay. Now next question. Which of the following items would not be included in the statement of changes in equity? Okay, so changes in equity. So changes in equity will have equity shares. The bank loan is a long-term liability. It will not be reflected in the changes in equity. Revaluation surplus, if there are any revaluation surplus, it has to be shown in the changes in equity, and the dividend paid also should be part of the changes in equity. So therefore the correct answer is part B. This will not be included in the equity statement. Which of the following statement about preference shares is true? They are talking about the preference shares. When you say preference shares, there are two types of preference shares: irredeemable preference shares and redeemable preference shares. Okay, so irredeemable preference shares are treated as equity because it will not be redeemed and it will be converted into share capital. So redeemable preference shares will be paid back to the preference shareholders. Okay, so which of the following statements about preference shares is true? All preference shares are classified as a liability in the statement of financial position, which is wrong, as I told you. If it is irredeemable, it is equity. Redeemable, it is a liability. So therefore, not all preference shares are classified as liability. Irredeemable preference shares are classified as a liability and redeemable preference shares as an equity in the statement of financial position, which is wrong. As I told you, irredeemable preference shares are treated as equity and redeemable preference shares are treated as liability. All preference shares are classified as equity in the statement of financial position, which is not correct. Irredeemable preference shares are classified as equity and redeemable preference shares as a liability in the statement of financial position. This is the correct answer. Okay, so let's move on to the other question. Which of the following statement is true in relation to right issue of share by an entity? So as I told you, right issue, there will be a cash inflow and it is issued at a discount, at a discounted price compared to the market price, and it's a liability. Okay, no cash is received by the entity as a result of making the right issue. Not correct. The entity issues shares for cash at market price of the shares. Okay, This is also not correct because it is issued at a discounted price. Okay, discounted price. The entity issues shares for cash at a price less than the market price of the shares. Yes. A right issue is not presented in a statement of cash flow, which is not correct because when you receive cash, it's a cash inflow. It has to be reflected in the statement of cash flows. Which of the following statement is true in relation to bonus issue of shares by an entity? So as I told you, there's a distinct difference between bonus share issue and right issue. The bonus share where we transfer reserves to the equity, okay, equity account. It's a capitalization of reserves to the equity. There's no cash inflow. Entity issues shares for cash at a price less than the market price of the shares. No, this is not bonus share. This is what do you call? This is not bonus share issue. This is we call it a right issue. Entity issues shares for cash at a market price of the shares. No, not correct. No cash is received by the entity as a result of making the bonus issue. Yes, this is correct. A bonus issue will be presented in a statement of cash flow. No, there is no cash inflow. Okay, now let's move on to the next question. State whether each of the following statements about dividend true or false. Dividends paid by an entity are excluded from the statement of changes in equity. False. This is false. Dividends received by an entity are included in the statement of changes in equity. No, it's in the are included in the statement of, yes, this is not included in the statement of changes in equity. It's false. Dividend received by an entity are excluded from the statement of changes in equity. Yes, true. This is part of your income statement. Dividend paid by an entity are included in the statement of changes in equity. A dividend paid has to be in the statement of changes in equity. Okay, now when an entity pays a dividend, what accounting entries are required to account for the transaction? So when the dividend is paid, you need to credit the bank and you need to debit the retained earnings. Okay, so share capital debit, no. Bank. Share premium, no. Bank. Retained earnings has to be debited and the bank has to be credited. So correct answer is C. Next question. Entity made an issue of 20,000 ordinary shares, $1 equity shares at a price of 1.75. So there is a premium of 0.75. Okay. So what accounting entries are required to record the issue of shares? So basically 20,000 times 1 will be the equity, which is 20,000, and 20,000 times 0.75 will be share premium, which is going to be 15,000, and the entire amount of 35,000 will be debited to the bank. So therefore the correct entry will be debit bank, credit share capital, no. Debit share capital, no. Debit bank 35, credit share premium 20,000, no. Debit bank account 35,000, credit share capital 20,000, credit share premium account 15,000. This is the correct answer. An entity, Taylor Company, issued 250,000 equity shares with a nominal value of 0.50 each and a share premium account balance of $100,000. So there is a share premium account, and what accounting entries are required of Taylor Company was to make bonus issue of 1 share for 4 held. Okay, so now there are total number of shares 250,000. So 4 shares, 1 share is issued for 4 shares held. So therefore the total number of shares will be bonus shares will be 250 divided by 4, which is 62,500, and that is issued at the nominal value of 0.5. So times 0.5, how much is that? 31,000. This is 62,500. So 62,500 times 0.5, which is 31,250. So this is merely a transfer of reserves to the equity. So therefore you need to credit share capital and you need to debit the reserve account. Now the available reserve is the share premium account. So therefore share premium account has to be debited 31,250. Share capital has to be credited. So the correct answer is part B. The next one, which of the following statements are correct? A limited company will always have both an equity share capital and share premium account. No, this is not correct. It will have an equity share capital account, but it may have a share premium account provided they issue at a share premium. So therefore this is not the correct Answer, a limited company will always have an equity share capital. Yes. And may also have a share premium account. Yes. If you issued at a share premium, yes, you will have a share premium account. A limited company will always have either a share premium account or a revaluation surplus account, which is not correct. So you may have a share premium or you may have a revaluation reserve account. So therefore the correct answer is part B. Which of the following would not be included in the statement of changes in equity? So would not be included in the statement of changes in equity. So share premium will be included, revaluation reserve will be there, irredeemable preference shares will be there. Redeemable preference shares is a liability. It's not part of the equity. So therefore the correct answer is D. Okay. Okay, let's move on to this particular question. The non-current assets register shows a carrying amount of 85,600 for non-current assets. In the general ledger, the balances recorded are the cost of non-current assets $185,000 and accumulated depreciation $55,000. Now you are given the non-current asset register balance as 85,600, where all the detailed assets are recorded in the register, and in the general ledger you are given the cost as 185,000 and accumulated depreciation as 55,000. If you take the difference will be the net book value. The net book value will be $130,000. Okay, so if you look at these two balances, the register balance 85,600 and the ledger balance is $130,000. The difference will be 44,400. Okay, there's a difference between the register and the ledger balances. So which of the following statement could explain the discrepancy between the register and the general ledger balances? So now you are given four answers. We need to choose the correct answer. Okay, so first of all, let's move on to this one. The omission of a land addition costing $30,000 from the ledger account and the omission of an asset disposal from the register, the cost is given as 25,600 and the accumulated depreciation is 11,200 at disposal. Now if you look at this, to correct the ledger balance, we need to add back this 30,000 as this was omitted from the ledger. So as a result of that, the ledger balance will increase by 30,000. Okay, so if you look at the ledger balance, this 30,000 is omitted from the ledger. So in order to correct this, if you correct this, you need to add back this 30,000. So as a result of that, the difference of 130,000 will increase by further 30,000. The total balance will be 160,000. On the other hand, if you look at the omission of the asset disposal from the register, now the cost of the asset is 25,600 and the disposal value is 11,200. So therefore the difference is 14,400. Now since this disposal is omitted from the register balance is overstated. So in order to correct that, it should be reduced by 14,400. The register balance should reduce by 14,400. So currently the register balance is 85,600. Since this was omitted, it was overstated. Now we need to correct it. We need to deduct it, 14,400. So therefore the adjusted register balance will be 71,200. So when you take these two differences, the difference will be now 88,800. So this does not fully explain the discrepancy. So this is not the correct answer. Now let's move on to the part B. The omission of an asset revaluation upward by 16,000 and a depreciation charge of 20,000 from the ledger account. Along with the omission of an asset disposal, carrying amount is 41,000 from the register. Now let's look at the ledger account. What has happened? Omission of an asset revaluation upward 16,600. So this was omitted from the ledger, the upward revaluation. So therefore it is understated. So what you need to do is you need to add back this 16,600. Omission of revaluation will increase the ledger balance by 16,600, and the depreciation charge of 20,000 also omitted from the ledger. So which means depreciation charge should be deducted. So it will decrease the ledger balance because the depreciation was omitted from the ledger balance. So therefore the asset value was overstated. So therefore in order to correct this we need to deduct it. However, when you take the net difference of these two, the net difference is 3,400. That will decrease the ledger balance. Okay, so this is a decrease the ledger balance by 3,400. So that will be so when you decrease this ledger balance 3,400, so that will be 126,600. On the other hand, the omission of an asset disposal, the carrying value was 41,000 from the register. So from the register, they have omitted disposal of an asset. So they have overstated the the register balance. So therefore register balance will reduce by 41,000 once it is corrected. So current balance is 85,600. Once you deduct this 41,000, it will be 44,600. So once you take the difference between these two, the difference will be 82,000. So this option also does not fully reconcile the discrepancy. Okay, this is not the correct answer. Now let's move on to the part C. Let's move on to part C, the omission of an asset disposal from the ledger account. The cost was 25,600, accumulated depreciation 11,200 at disposal, and the omission of a land addition costing 30,000 from the register. Now when you look at the ledger, omission of an asset disposal from the ledger. So if you look at the cost and the accumulated depreciation, the net impact is 14,400. Okay, so since this asset disposal was omitted, the ledger balance was overstated by that 14,400. So in order to correct this, what we need to do is we need to deduct this 14,400 from 130,000. Okay, so this will reduce the ledger balance by 14,400. So the adjusted balance will be 115,600. Now on the other hand, the omission of a land addition costing 30,000 in the ledger, in the register. So in the register 30,000 was not recorded. It's an addition. So therefore the register balance was understated by 30,000. So therefore in order to correct that we need to add back, so it will increase the balance 85,600 plus 30,000, 115,600. So this will match the ledger balance. So therefore this option, this scenario explains the discrepancy correctly. So therefore the difference is 0, so this should be the correct answer. But however, let's move on to part D and we will see the impact. What is the impact? Part D, omission of an upward revaluation by 16,400 from the register. So in the register 16,400 was not recorded. So therefore you need to add back this 16,400 to the register balance 85,600. So that will increase to 102. However, the accidental debiting of a depreciation charge, this is an accidental debiting of a depreciation charge 28,000 to the accumulated depreciation ledger account instead of crediting it. So usually depreciation amount has to be depreciation expense account debit, accumulated depreciation account should be credited. But in this case, what has happened? This 28,000 was debited to the accumulated depreciation account. So therefore, this accidental debiting of a depreciation charge 28,000 to the accumulated depreciation account, instead of crediting it, effectively reduce the accumulated depreciation balance, which incorrectly increase the carrying amount of the ledger balance. Okay, the carrying amount of the ledger balance. To correct this mistake, the accumulated depreciation account the accumulated depreciation account needs to be credited twice the depreciation amount, because instead of crediting, they have debited the accumulated depreciation account. So therefore, you need to, in order to correct this, you need to credit twice the depreciation account. So that will reduce the net book value by 56,000. So the adjusted ledger balance will be 74,000. So once you take the difference will be 28,000. So this is not the correct option. So therefore, the correct answer is C. So this is the answer for this particular question.
Let's move on to the other question. At 30th September 2012, the following balances existed in the records of Max Company. You are given the plant and equipment cost 645,000, accumulated depreciation 300,000. Okay, so you are given 30th September 2012, the cost of the plant and equipment $645,000 and accumulated depreciation amount $300,000. So these are the opening balances. During the year ended 30th September 2013, this is opening 30th September 2013, plant with a written down value of 32,000. Now you are given written down value of 32,000 was sold for $40,000. This plant was sold for $40,000. The plant had originally cost 60,000. The original cost was 60,000, and the written down value of that particular plant was 32,000, which was sold for 40,000. The plant purchased during the year cost 135,000. In addition to that, the company has purchased $135,000. This is new addition. It is Max Company policy to charge a full year depreciation in the year of acquisition of an asset and none in the year of sale, using a rate of 10% on the straight line basis. Okay, so depreciation straight line basis method 10%. The policy is year of acquisition full depreciation regardless of the date of purchase, and the year of disposal there is no depreciation. What was the carrying amount that should appear in Max Company's statement of financial position at 30th September 2013 for plant and equipment? Okay. Now, so you need to identify. So now you need to identify the carrying value as of 30th September 2013. Okay. Now, let's open up two accounts. Let's say this is a cost account, this is a cost account, and this is the accumulated depreciation account. Okay. In the cost account, we had 645,000. This is the opening balance, 645,000. This was 30th September 2012. So we can say 1st October 2012. Balance brought forward. So here the same balance brought forward 300,000. This is the opening balances. Now during the year, a particular asset was sold. The cost was 60,000 and the written down value was 32,000 and the sold amount was 40,000. Now when you sell, usually you transfer this particular asset to a disposal account, right? So this is a normal way of calculating the profit, which is not required, but I will show you how to calculate that also. First and foremost, what you need to do is you need to transfer the cost from the cost account to the disposal account. So when you transfer disposal account, this is 60,000 and the disposal account is debited with 60,000 cost. In order to calculate the profit on disposal, you need to compare the disposal cost with the accumulated depreciation. Now in this case, you are not given the accumulated depreciation. How do you calculate the accumulated depreciation? So written down value means cost minus accumulated depreciation. Now since you are given the cost is given 60,000. This is not given, okay, this is not given, and the written down value is given as 32,000. Okay, so it's very easy to identify the accumulated depreciation if you are given the cost and the written down value. So simply 60 minus 32,000 will be the accumulated depreciation, which is 28,000. Okay, this 28,000 has to be removed from the accumulated depreciation account. So what you need to do is you need to debit accumulated depreciation account to the disposal, which is accumulated depreciation 28,000. Then you have the selling price. You can say when you sell, you debit the bank account and sorry. Now you have the sold amount, the value 40,000. So bank debit, credit the disposal account 40,000. Okay, so thereby you can calculate the profit or loss from this. So basically it is 68,000. So 8,000 is the profit. This is not required. This is transferred to the profit and loss account. Okay, so what is important here is this value 28,000. You need to identify this 28,000 simply by deducting cost minus the written down value, which is 28,000, has to be removed from the opening balance, which was there in the opening balance. 60,000 was there in the opening balance, that we have removed from this particular account because we need to identify the carrying value of this particular asset. Okay. Now during the year they have purchased additional asset of new addition of $135,000. So bank credit, you debit 135,000. So this will be the addition. Apart from that, there are no other information given. So therefore, what you need to do is you need to identify the carrying value of the asset. Okay. Now, what is the closing balance of this account? The cost is 780,000. So here 720,000. The closing balance carried forward. And the accumulated depreciation account, we need to provide depreciation now. Okay, so now this 720 consists of two components. One is from the opening balance we remove disposal 60,000, so you can take that difference. plus you can add the new addition 135,000. So what is the depreciation policy? The year of disposal, year of purchase, you need to provide full depreciation. So therefore, we can on this amount, we can straight away we can calculate the depreciation. Okay. So the total cost 720,000 times 10 will be 72,000. Otherwise, you can separately calculate 645 minus 60. What is the depreciation? 10%, and 135,000 the total depreciation. Okay. This depreciation 72,000 has to be provided. So depreciation account will be debited and it will be credited to the accumulated depreciation account. So this is depreciation expense. So when you balance this, what is the carrying forward balance of this? 372 12 1 3 344 372,000 minus 28,000, so 344,000. So the cost is 720,000. Your accumulated depreciation is 344,000. So what is the carrying value or the written down value of the total assets? Will be 720,000 minus 344, which is going to be 376,000. Okay, so this is the answer for this particular question. So let's move on to the other question. What is the question?
Payable received a statement for the month ended 31st March 2023 from one of its suppliers, Sigma, showing balance due of $4,684. Upon reviewing the payables ledger account.
Okay. Now P received the statement from S. Okay. S is the supplier. P is the buyer. Okay. So therefore P has to pay. Right? And S has to receive. Okay. He has to receive this balance, right? In his books, it's a receivable balance. In P's book, it's a payable balance. Is that right?
Yeah.
Okay. So he received a statement from Sigma showing 4,684 to be paid. Okay. So upon reviewing this, what he has identified, just read out for me.
The following differences were identified.
Yeah.
Pharmaco had not recorded an invoice issued by Sigma of 584.
Wait. P has not recorded. P has not recorded what?
An invoice.
An invoice. How much?
584.
584. Okay. Then what he has not recorded?
A credit note issued by Sigma.
Credit note issued by Sigma. How much?
276.
276. Okay. Then
An automated bank payment of 1,342 made recently was not recorded on the statement from Sigma.
okay. Bank payment, automated payment made by whom? P.
Yeah.
P made the payment, but who has not recorded?
Sigma.
Sigma. Sigma has not recorded. How much?
1,342.
42.
Yeah.
Okay, 1,342. Now what is the question? What is the question? What is the question? What do you need to identify?
The payables ledger account balance.
Okay. Now payables ledger account of P not given, right? You don't know. What is given? The statement sent by Sigma 4684. Since you are not given the statement of P, you don't know the balance. Then how you can arrive at that balance? How you can arrive at that balance? You can arrive at that balance based on this. Okay, so therefore this balance, the invoice has not been recorded, 584. Who has not recorded? P has not recorded. So he has to record it, right? To record, do you have the balance? No. Okay, so therefore based on this you can't determine the P's payable figure. Who has not recorded the credit note? P has not recorded. So do you have the balance here? No. So therefore can you, based on this, can you arrive at the payable balance? You can't. You have to understand this. Okay, so this information is given to confuse. Okay, now the bank payment made by P, who has not recorded? Sigma. So Sigma has not recorded this 1342. Now P, considering this, he will adjust his books. Okay, now once he adjusts this book, this he has already adjusted in his books, right? Only thing is he has not recorded. So therefore from 4684, if he has not recorded this 1342, he has to record it. Okay, he has collected this money, right? So he has to deduct it, right? So he should deduct this 1342. How much should be the balance?
3,342.
3,342. Is that clear? Is that clear?
Yeah.
Okay. So you identify
What is relating
to P, what is relating to S, what information is given, what information is not given. Based on that, you have to identify the correct balance. Is that clear? Okay. So we'll move on to the next question. Okay, now let's discuss this question. Okay. Credit sales to various customers 100,000. AG decided to make an allowance for receivable 5% at the year end. Okay, this is in the first year. Okay, so when you take the accounts receivable account, how much is the total credit sales? 100,000, right? So you need to open accounts receivable account, and sales account has to be credited. So which is 100,000. So you debit 100,000 sales. This is in the first year 2001. So let's say 31st December 2001. Okay, and sales account has to be credited. Now at the year end, AG decides to make an allowance for receivable of 5%. Okay, so which is irrecoverable. There's a doubtful. This is doubtful. Okay, so you have to make a provision of 5% on 100,000, which is going to be how much? 5,000. So what is the double entry for that? How do you record that particular transaction? You need to debit your expenses and you need to credit your provision account, no? So just open up two accounts. One is irrecoverable debt expense account and allowance for accounts receivable. Okay, so 100,000 times 5% is 5,000, right? So you debit 5,000 here and credit 5,000. Okay, so this is allowance for receivable and this is irrecoverable debt expenses. So at the end of the period, at the end of the year, what do? You need to transfer this expense account to the P&L account, profit and loss account, to calculate the profit. So this will be transferred to the profit and loss account, 5,000. This is closed. And this allowance for accounts receivable, where do you transfer? To the balance sheet. Okay. So this account will be balanced, 5,000, balance carried forward, 5,000 to the next financial period, balance brought forward here, 5,000, right? And in the same way, this 100,000 also will be transferred, 100,000, balance carried forward, 100,000 to the next financial period. So this is the first year. Now the second year, okay? Second year, what has happened? Credit sales to various customers, 75,000, and cash collected 90,000. AG decided to continue the allowance for receivable 5% at the year end. Okay, so now we will open up the accounts for the next year, which is the accounts receivable account, AR account. We have a balance brought forward, balance of how much? 100,000. Is that correct? And we have allowance for receivable, how much? Balance brought forward. How much? We have 5,000. Okay? So that's the balance sheet figure, no? We already provided a doubtful provision of 5,000 in the first year, which is we have debited expense account and we have credited the provision account. That provision account will be the opening balance here, and this is the opening accounts receivable. Now there's a credit sales of 75,000. So sales credit, debit accounts receivable 75,000, and also the cash is collected 90,000. Okay, so 90,000 bank account debit, credit your receivables. Okay, so bank debit and here credit 90,000. Now still AG wants to continue the same provision of 5%. Okay, now you identify what is the receivable balance at the year end. 175,000, 175,000. So what is the balance? 175 minus 90, how much? 85,000. Balance carried forward, 85,000. Okay, so 175,000, this is sales. Okay, this is the bank collected, and 85,000. Is that correct? So 85,000. Now he wants to continue the provision 5%. So 85,000 times 5%, how much? 85,000 times 5%, how much? How much? 4,250.
Yeah.
85,000 times 5%. 4,250. Now what is this 4,250? What is this 4,250?
Closing.
Yes, this should be the closing balance, right? Why? Because we had an opening balance of 5,000, which was provided based on the previous receivable, which we debited the irrecoverable debt account and we created the provision account. Okay, so we have an opening balance of 5,000. Now your closing balance is 85,000. On this, if you take the provision, this is normally known as general provision. As a whole, you are making a provision, general provision. So you are making on this 5%, 85,000 5%, 4,250. So which means you have over provided, no? There is an over provision of 5,000. So which has to be reversed to the profit and loss account. So in order to reverse, what you should do, you take your closing balance 5,000, 5,000, and your closing balance should be 4,250 now. Okay, 4,250. and 750 has to be reversed to the profit and loss account. Okay, so this is a profit. Sorry, now where do you reverse? To the irrecoverable debt expense account, right? Okay, that has to be reversed. So irrecoverable debt expense account has to be credited here. Now this is a credit balance. Okay, so therefore this 750 will be transferred to the profit and loss account as a credit balance 750. Is that clear? Okay, so you understand the concept of irrecoverable debt and the allowance for receivable. How do you make adjustments? Supposing, let's say this is 5,500, which means you have under provided. There's an under provision. So 500 has to be provided, additional provision, additional allowance. So that will be debited to your expense account. So this expense account will be transferred to the next financial year. This financial year as an expense. Now here it's a credit balance, so therefore this has to be credited to the profit and loss account. So this is allowance for receivable, and this has to be transferred to the profit and loss account. Okay, now we'll move on to the third year. This is a continuation. Okay, this is the first year, which is 2001. This is 2002, and now we are moving on to 2003. Okay, so I will erase this part. We'll take the same information from the second year. Okay, third year. Now let's move on to the third year. Before that, we'll take the opening balances. Let's take the opening balances. Accounts receivable balance brought forward. How much? This is 85,000. Take 85,000. And balance brought forward in the allowance for receivables. How much is that? 4,250. Is that correct? Correct. Now there is a credit sales to various customers 105,000. Now you need to record this particular transaction. How do you record? Accounts receivable debit, credit your sales. Okay, so sales account credit, accounts receivable account debit 105,000. Then cash collected 100,000. So bank debit, credit your accounts receivable. How much? 100,000. Now AG decided to continue the allowance for receivable of 5% at the year end after considering the followings. There are some additional things you need to do. What are those? You are given a specific provision of 2,500 to be provided, plus a bad debt write-off of 1,000 to be provided. Okay. Now AG has identified 1,000 worth of receivable is to be written off. Why? Which cannot be collected. Now maybe the customer is bankrupt. So therefore this 1,000 has to be removed from your AR receivable, accounts receivable. You understand? So therefore what you should do, you should write off that amount to the irrecoverable debt expenses account. Okay, how much is that? 1,000. First of all, you just remove the write-off, which is uncollectible. Okay, so irrecoverable debt. This is a bad debt of 1,000 to be debited to the irrecoverable debt account. This is accounts receivable. Now, what is the receivable balance now? So here 190,000, 190,000. So your balance is 89,000. Your balance is how much? 89,000. Okay. Now they are saying, can you calculate 5% allowances, general provision on this amount 89,000? Can you collect or not? Let me know. What is your understanding? Can you collect general provision on this 5%? No. Okay, it's a general provision. As a whole, you are making a provision of 5%. But in addition to that, AG has identified a specific provision, specific allowances of 2,500. Maybe out of this pool of customers, he would have identified one particular customer which is going to be a doubtful debt. You understand? Maybe he is in a financial crisis or is going to go bankrupt. So therefore, he has identified this particular customer as a specific provision to be made. Okay? So therefore, if you apply 5% on this, which is not correct. Okay? So therefore, what you should do? 89,000, I will erase this part. 89,000 minus the specific provision or the allowance. How much is that? 87,000. You calculate 5% on this 87,000. How much is that? 87,000 times 5%, which is going to be 4,350. Okay, this is this we can say 5% general provision. 5% general provision or allowances, 4,350. In addition to that, you have a specific provision. How much is that? Specific provision. How much? 2,000. So what should be your carried forward balance in the allowance for receivable now? It should be how much now? 6,350, right? Now what has happened? Your opening balance was 4,250. Now we calculated the closing provision to be 6,350, which consists of 5% general allowance and specific provision. When we calculate this 5% general provision, we remove that part from the total receivable. Okay, if you calculate 5% on 89,000, which will not be correct. Okay, so you remove the specific provision and you calculate, which is 4,350, add back the provision, and that will be the new, what is the closing balance. So take the closing balance in the allowance for, this is allowance for receivable, 6,350. 6,350 balance carried forward, 6,350 and 2,100. What is this? Where do you charge this? To the expense account. Okay, 2,100 allowance for receivable. This is now under provision. Okay, provision is under provided. Now you have to increase the provision. So when you increase the provision, the difference has to be charged to the irrecoverable debt expense account, which is 2,100, and your profit and loss account will be charged with how much? 3,100. Is that clear? When you take an extract from the balance sheet or the financial position, okay? So when you take the statement of financial position under current assets, okay, you will have what? Your receivable balance, how much? Your accounts receivable balance will be how much? 89,000. Okay, from 89,000 you need to deduct allowance for provision, allowance for receivables. Receivables, how much? 6,350. Okay, so you deduct 6,350 and show the difference. How much is that in the statement of financial position? So your 89,000 minus 6,350, how much? 82,650 will be your net receivable in the balance sheet, and the P&L account we will be charging 3,100 in the 2003 year, third year. Is that clear? Okay, so we can discuss other questions relating to irrecoverable debt and allowance for receivable. Okay, thank you. Is that clear?
Yeah.
Huh? Now you will not have any doubts.
Yeah.
Okay, this I clarified, specific provision and general provision. Thank you, Mita.
You're welcome.
Okay, let's try to discuss this particular question. AG's annual inventory count took place on 7th July 2016. The inventory value was $38,950. During the period from 30th June 2016 to 7th July 2016, the following transactions took place. You are given sales 6,500, purchases 4,250, and the markup is 25% on cost. So what is the AG's inventory valuation at 30th June 2016? Okay, so let's analyze the question. The inventory count took place on 7th July 2016. Okay, 7th July 2016, the inventory value was 38,950. Then during the period 30th June 2016 to 7th July 2016. Okay, so which means 30th June 2016 until 7th July 2016, transactions are given, the sales and purchases are given. So basically this stock valuation was done on this particular date. So therefore this inventory value will be the closing inventory value, stock. So you are given sales and purchases, and also the markup is given as 25% on cost. So what is the AG's inventory valuation on 30th June 2016? Okay, so now let's analyze this. If you want to calculate the gross profit, you need to identify your sales, then you have to deduct the cost of goods sold. So sales less cost of goods sold. How do we determine the cost of goods sold? Opening stock, purchases minus closing stock. Okay, now you are given the sales value as 6,500. Then purchases 4,250. The purchases value is 4,250, and also the closing stock is given 38,950. So opening stock plus purchases minus closing stock will be your cost of goods sold. Then you can identify the gross profit. Now with these details, so what is required is to identify the opening stock value. Now if you can identify the total cost of goods sold, then straight away you can identify the opening stock. Otherwise, if you can identify the gross profit, then we can identify the cost of goods sold. In turn, we can identify the opening stock. Now in this case, you are not given these two numbers. These are unknown, but you are given a clue, which is the markup. The markup is 25% on cost. The cost means the cost of goods sold. Okay, the markup is calculated on cost. So 25% on your total cost. So if you can identify this, on this 25% will be the gross profit. Okay, if you take 25% on this will be the gross profit. Now since this value is not known, what we can do is, let's assume your cost of goods sold as 100. If you add the markup 25, what will be the selling price? It should be 125. So this is the cost. This is the markup. The cost plus the markup will be the selling price. Now if you substitute this to this value 6,500, okay, so which is the selling price, which is the sales. So therefore if you take this 6,500 divided by
125 and times 25, which is the markup. So what will be the profit? You can determine the gross profit. Okay, so 6,500 divided by 125 times 25. So which will be how much? 6,500 divided by 125 times 25, which is going to be 1,300. So therefore, the gross profit will be 1,300. Otherwise, if you multiply this by 100, so that will be your cost. Okay. So 6,500 divided by 125 times 100 will be the cost, which is going to be 5,200. Otherwise, 6,500 minus 1,300 will be the cost of goods sold, which is your cost. Now, what is this value? Simply, you add back this and deduct this, you will get the opening stock value, which is going to be 38,950 plus 5,200 minus 4,250. So that will be 39,900. Okay, so this is how you identify the cost of goods sold when the markup is given. Okay, and there is another way that you can easily remember this to identify the cost of goods sold. So what is the other method? So what you can do is, since you are given the markup as 25%, now convert this 25% into fraction. So 25% is equal to 1/4 quarter. Okay, 1/4. To convert this into margin, so what you can do is you add 1 to this 4, so that will be 1/5. Okay, so if you apply 1/5 of 6,500, so that is going to be 1,300. Simply, if you take an example, let's say the cost is 100. Sorry, let's say your selling price is 100 and your cost is 75, then the gross profit is 25. If you take the gross profit margin, which is GP divided by sales times 100. So in this case, 25 divided by 100, which will be 25%. If you convert this into fraction, 1/4. And if you calculate the markup will be calculated based on the gross profit divided by the cost times 100. So here the gross profit is 25 and cost is 75, times 100 is 33 and 1/3, which is going to be 1/3. So here 1/4. This is the margin. This is the markup. From markup to margin, what you need to do is just simply add 1, so that will become 1/4. In this case, since you are given 25% as markup, the fraction is 1/4, simply add 1, so it will be 1/5. Okay, so this is another way that you can identify either the cost of goods sold or the gross profit. What is the question? Can you read out for me?
A business sold goods that had a net value of 600 to Lahari.
Net sales value, right?
Yeah.
Of 600. So here the net sales value is, this is net, not net of sales tax, right?
Yeah.
So this means this is the list price. What is the sales tax rate?
17.5.
17.5. So if you calculate, if this is a list price 600, okay, and the sales tax is 17.5, how much is the tax?
105.
It is 105, right?
Yeah.
600 times 17.5, which is 105. Okay, so if this is the sales value 600 and tax value is 105, how much is receivable from the customer?
600 plus 105.
Yes. So you need to collect, the company has to collect 600 net sales, okay, plus the VAT portion
Yeah.
or the sales tax portion. So the total receivable is how much? 600 plus 105. Okay. So therefore you can debit accounts receivable account. Okay. 705. The total 705. Then of which 105 is payable to the tax authorities. It's a sales tax payable, right? This is debit, this is credit, 105, and your actual sales is how much? Actual sales is going to be 600. So that will be recorded in your books, right? So sales credit 600. Okay? So this is the double entry. So next question. What is the next question?
Later, a customer
Mhm.
returned goods to streamer that had a net value of 200.
Now they are talking about what? They are talking about what?
Purchase returns.
Purchase, not purchases return.
Oh, sorry, sales returns.
Okay.
Yeah, sales returns. Yeah.
So how much is the sales return?
200.
200. So net sales return. Okay. Value is 200. How much is the sales tax amount?
17.5%.
17.5%. So this is net sales, means this is the listed price. Okay. So on this 200, how much is VAT or the sales tax?
35.
35. Okay. Now this is with regard to sales return, right?
Yeah.
How do you record that?
It's the opposite, right?
Opposite of the sales.
Yeah.
Okay. Now this 200 plus 235. Okay. 200 plus the 35. 235 was receivable from the customer previously. Now since it has been returned, what happens? You need to reverse the receivable amount. But when you return it, you have to credit. Okay? Accounts receivable balance. Okay? So if you take
Okay.
Okay.
About sales.
okay, so sales and the VAT portion. This was payable previously. Okay? Now since the customer has returned it, it becomes what? The reversal of the entry. Sales tax was credit, now it has to be debited. And likewise, this 200 is a sales return. Okay? So therefore, what you should do, sales return account should be debited with 200 and sales tax account should be debited with 35 and accounts receivable should be credited with 235. Is that clear? Clear or doubt?
No.
Okay, fine. So let's go to the next question. Okay. So read the question. What is that?
Preet is a sole trader
Oh.
whose accounting records are incomplete.
Oh.
The sales are cash sales, and during the year, 50,000 was banked, including 5,000 from the sale of the business car. Preet paid 12,000 wages in cash and
Oh.
withdrew 2,000 per month as drawings. The cash and the till at the beginning and the end of the year was 300 and 400 respectively.
Oh, it's an incomplete records, right? How do you do that? Just prepare your cash account. Okay. Cash account. How much is the opening balance?
300,
Closing balance?
400.
400, no? Balance carried forward 400. Okay. Now first of all, what is the first thing he has done? He
Cash sales,
cash sales.
including the sale of the business car, 50,000.
What he did?
That's cash sales.
Not cash sales. What he has done that? What did he do for that 50,000?
He banked.
He banked. Okay. So it's not a cash sales. He banked 50,000. We are just preparing the cash book here. Okay, 50,000. Then what is the next? What is next?
12,000.
What is 12,000?
Wages, cash.
He paid.
Yeah.
So he paid wages, right? Sorry. Wages how much? 12,000. What else?
2,000 per month as drawings.
Okay, drawings 2,000 times 12, 24,000. What else? What else?
That's it.
Okay, now but this 50,000 banked amount, you are given, you are told what? 50,000 including what?
Car sale.
Car sales. Okay, so when you sell a car, you will receive the cash, right? So, receipt from car sales, how much? 5,000, right?
Yeah.
5,000. Now, how much is your cash sales excluding that? Find out. So here 50,000, 62,000, 72,000, 76,000, 78,000. Sorry, 5, 6, 7, 8. 90,000. Sorry, 400 here. 400.
81, 800. Wait, no, 81, 100.
81, 100.
100.
Okay, so this is going to be the cash sales. Understood? Right? Okay, now let's take that. Let me. So, what is the next question?
The following transaction took place during Australia's first month of trading. Credit sales of 121,000, exclusive of sales tax. Credit purchases 157,110, inclusive of sales tax. Payment to credit suppliers of 82,710, inclusive of sales tax. Subject to 20%.
Okay, how much is credit sales?
121,000.
121,000 inclusive of tax or excluding tax?
Exclusive.
Exclusive, huh? Okay, so then straight away we can calculate 20% on this. If it is excluding tax. Then purchases,
Including
how much is purchases?
157,110.
110. So to calculate VAT component or the sales tax component, divide 120 times 20. How much? How much is your sales tax?
26,185.
26,185. What? Oh, 24,200 right here. 24,200, and here 157, 110 divided by 120 times 20. 26,185 here. Huh?
Yeah.
Okay. Then why they have given another line? What is that?
Payment
Payment on?
to credit suppliers.
Okay, so you have given payment on credit suppliers. How much? How much?
82,710.
82,710, including tax or excluding tax?
Inclusive.
Inclusive of tax. So, do you consider this in your tax computation?
You do?
Why? Do we record sales tax? At which point of time we record sales tax? Is it at the time of recording sales and purchases, or at the time of payment? Payment of to customers and suppliers. Customers and suppliers. At which point we record sales tax?
The first one?
Yeah, at the time of recording sales, you need to record the sales tax. You understand? At the time of recording your purchases, you will be recording your sales tax. So which means whatever the purchases, look here, this 157,000 is your total payable, right? How you would record this? Suppliers, purchases, okay? You will debit with the total price excluding the tax. You understand? So this is, how much is this 157,110? That is payable, right? So your accounts payable is how much? 157,110. Okay? And your sales tax, okay? Out of this 157,110, credited. What is the debit entry?
For payment.
No, I am talking about you are trying to record the purchases.
Ah, yeah, then purchases you debit and sales tax you debit.
Okay, how much is that? Regarding purchases, I am not talking about sales. Purchases, what is the debit entry?
26,185.
Okay, 26,185. Purchases, how much?
139.25.
139?
25.
25? 130?
925.
925. Okay.
Yeah.
See, now you have recorded the purchases. You recorded the sales tax. Now the accounts payable. Now they paid to the credit suppliers 82,710. Okay. This is including taxes, right? This is also including taxes, right? They are just paying this 82,710. If you calculate tax again, you will double count, right? You are duplicating because this is a payment. This is the total payable amount to the accounts payable or the suppliers, including the tax portion. You understand? So you are paying including the tax. This is a payable amount. Now you are paying of this 82,710, which is including tax. This is basically you are settling your suppliers.
Yeah.
So why to calculate again sales tax included here into your calculation? You will double count. This is already included here in this amount. Okay? So don't consider that. Is that clear? Okay? So therefore, if you take the difference in the sales tax, now sales tax receivable is 26,185, payable is how much? 24,200, right? 24,200. So what is the difference? What is the difference? Calculate. 26,185 minus 24,200. 1985.
Yeah.
Is it payable or receivable?
Receivable.
Why receivable?
Because purchases.
Okay, your input tax is more than the output tax. So it's a refund.
Yeah.
Okay, you can get the refund from the department. So this is a receivable amount. So this is the answer. Okay, is that clear? Okay.
Yes.
Next, move on to the next question. I will erase this first. Okay, what is the next question?
Jupiter Co. returned unsatisfactory goods to Saturn Co. The goods had been sold on credit by Saturn Co. at 100 plus sales tax of 20. What accounting entries are required by Saturn Co. to record the return of goods?
Okay, who sold the goods? What is the name?
Saturn Co.
Who sold to whom?
Saturn Co.
Okay.
Sold to Jupiter.
Saturn Co. sold to whom?
Jupiter.
Jupiter. Okay. Okay. So sold. Okay. Now he is returning, right?
Yes.
How much?
100.
100 is the list price. Okay. How much is the tax?
Sales tax.
How
20.
much? 20. So he is returning how much? Total
120.
120. In whose books you have to record?
Saturn.
Okay. So seller's book, right?
Yeah.
In seller's book, okay, Jupiter will be a receivable amount, right? Okay, now the customer is returning. So therefore what you need to do? You need to record a sales return. Okay, so how much is the sales return? How do you record that? Sales return,
Debit.
debit 100, sales tax, debit how much?
20.
20, accounts receivable how much?
100.
100,
120.
20.
Yeah.
Is that clear?
Yeah.
Okay, so what else?
That's
So
it.
that's it, no? Okay. Now what you do, you try to finish it off all the questions. Then we will move on to inventory next week.
Okay.
Have it.